Welcome to the channel, Stock Market Explained in 60 Seconds. Please like, share, and subscribe. Today, we are looking at ETFs. ETF, Exchange Traded Fund, is, but the magic of how they function and why they often feel safer than picking a single winner is where things get interesting.
Think of a single stock like buying a single ingredient, a tomato,
Whereas an ETF is buying the whole prepackaged salad. If the tomato is rotten, your snack is ruined. In a salad, one bad tomato won't spoil the whole meal. How ETFs actually work. An ETF is a fund that owns underlying assets, stocks, bonds, gold, or even oil, and divides ownership of those assets into shares. The basket. A fund manager buys a collection of assets based on a specific theme, e.g., the 500 largest U.S. companies or green energy firms. Trading. Unlike mutual funds, which only trade once a day after the market closes, ETFs are traded on an exchange throughout the day, just like Apple or Tesla stock. The price. The price fluctuates based on the value of the ingredients inside the basket. ETF versus individual stocks. The comparison. First, diversification. Individual stocks offer low diversification, all eggs in one basket. ETFs, however, provide high instant variety. Next, risk profile. Individual stocks typically have high volatility, while ETFs usually have lower volatility. Regarding effort, individual stocks demand high research for every company, whereas ETFs require low effort, passive, set-and-forget investing. Finally, dividends. Individual stocks pay dividends from one company, but ETFs aggregate dividends from many companies. Why are ETFs safer than regular stocks? Safe is a relative term in investing. Nothing is 100% risk-free, but ETFs offer a different kind of security through diversification, protection against bankruptcy. If you put all your money into one tech company and it goes bust, you lose 100%. If that company is part of an ETF that holds 500 other companies, that bankruptcy is just a tiny blip rather than a catastrophe. Stocks are prone to mood swings based on news, CEO scandals, or bad earnings reports. ETFs represent entire sectors or markets, which tend to move more smoothly over time. Most ETFs are passive, meaning they track an index. If a company in the index starts failing, it eventually gets kicked out and replaced by a winner automatically. Not all ETFs are created equal. An ETF that tracks the S&P 500 is generally considered very stable. However, leveraged or inversed ETFs are highly complex and can be much riskier than regular stocks. Stick to broad market index ETFs if safety is your priority. It's much cheaper to buy one share of an ETF than it is to buy 500 individual stocks and pay the trading fees for each. You can gain exposure to gold, real estate, or international markets without having to actually store gold bars or buy a house. Due to the way they are structured, the creation-redemption process, ETFs generally trigger fewer capital gains taxes for investors than mutual funds. Please like, share, and subscribe. What are your favorite ETFs? Let us know in your comments.